Okay, let's unpack this. Welcome back to your daily intelligence briefing. Today, the market is really showing us, I think, a textbook example of a deep conflict.
Yeah, it's quite the divergence, isn't it?
It is. You've got this sharp, short-term pain, seems like it's driven by macro fears, clashing directly with, well, overwhelming strength from the long-term builders in the ecosystem.
Exactly. And that tension is really what we need to zero in on today. You
Yeah.
see institutional investors systematically, reducing risk. We see it in the price action.
Mm-hmm.
But then you look at the balance sheets, you look at the regulatory progress, and the actual foundation, the structure of the industry, it's getting demonstrably stronger.
Right. So our mission today is to analyze that tension for you. We have to track the immediate price defense because, let's face it, the sellers are powerful right now.
They are.
But we also absolutely have to put that in context against these, frankly, fantastic quarterly results just posted by the major infrastructure players.
A tale of two markets, really.
Let's start with the pressure. What's driving the price down? It really feels like the hangover from the Federal Reserve's latest policy guidance is just lingering.
It is. It triggered what looks like a pretty classic sell the news move.
We saw Bitcoin dip, didn't it? It tested that critical psychological level below $107,000.
It did, before finding some footing and stabilizing around $109,000. It's definitely a defensive posture for now.
And this selling, it's not just Bitcoin, is it? The systematic de-risking is hitting altcoins pretty hard. Ethereum, BNB, Solana, all dropping over 4%.
Yeah, broad-based weakness.
But what really signals, I think, the institutional hand here is that high correlation with traditional risk markets. The correlation coefficient with the Nasdaq has surged to, what, 0.88?
0.88. That's incredibly high.
And that high figure tells us institutional money is basically treating Bitcoin just like any other tech stock or risk asset when they decide to pull back.
And we know exactly how they're pulling back. I mean, the most critical indicator confirming this institutional behavior has got to be the U.S. spot Bitcoin ETFs.
The flows.
Yes. They recorded a second consecutive day of major net outflows. On Thursday, $488.4 million left.
Wow.
And that followed Wednesday's $470 million outflow.
Okay, so that is nearly $1 billion pulled out in just 2 days. That figure is just staggering.
It's huge.
To put it in context for you, that's almost half the quarterly transaction revenue Coinbase just reported. Gone, out of the system in 48 hours.
Yeah.
Why? Why are portfolio managers reacting with such force now, especially when the Fed did actually deliver a rate cut?
Well, the problem seems to be in interpreting the Fed's guidance, or maybe the lack of stronger guidance. Institutional managers, I think, were hoping for, maybe expecting, a much stronger commitment to future monetary easing.
Right, a signal that liquidity would be flowing more freely soon.
Exactly. And since the Fed only delivered the cut, but didn't really offer that strong commitment to near-term easing, well, that reduces the future expected yield, the perceived yield, of basically every single risk asset.
Okay. So because the future isn't looking quite as liquid as they had hoped, they're forced to proactively de-risk now.
That's the thinking. It's a portfolio management move. It's driven almost entirely by these global liquidity expectations, not necessarily, a fundamental critique of Bitcoin itself at this moment.
Got it.
Now, if we look at the technical levels this creates for you, the immediate hurdle, the resistance to overcome, is hovering around $110,700.
Okay. And what's the line in the sand, the key support level we need to watch?
That's the critical zone between, let's say, $105,400 and $106,400. Now, what's really important for you to know here is that this lower boundary aligns almost perfectly with the historical minor cost basis.
Okay, can you explain that briefly? Why is the minor cost basis so critical? Why does that specific level matter so much?
Well, this zone is critical because it basically represents the average cost of production for the mining industry. If the price dips consistently below this cost basis, it starts to force the high-cost producers, the miners, to potentially sell their accumulated Bitcoin holdings just to cover their operational expenses.
Or even shut.
Or even shut down entirely. Exactly. And that action, that selling pressure, could potentially accelerate a downward spiral. So defending that zone becomes really paramount for short-term stability.
Right. So while the institutions are pulling back because of these macro fears, we absolutely have to look at the other side of the ledger, specifically the balance sheets of the companies actually building the rails for this ecosystem.
Yes, and this is where the narrative just completely flips. I mean, let's look at Coinbase's Q3 2025 earnings. They reported a huge beat.
Huge.
$1.9 billion in revenue, 1.44 earnings per share. significantly surpassing what the analysts expected. That kind of performance, it signals genuine market health underneath the surface noise.
And the activity was driven by volume,
Right.
right? Transaction revenue jumped up to $1 billion.
Supported by $295 billion in total trading volume. It's substantial activity.
And interestingly, within those numbers, we saw a clear rotation towards Ethereum. ETH accounted for, what, 22% of trading volume? That's up from 15% last quarter.
That indicates they're successfully monetizing activity across the board, both Bitcoin and the broader smart contract ecosystem. And, importantly, they put their money where their mouth is. They added another 2,772 BTC to their corporate treasury this quarter.
Okay, but let's step back for a second and address the paradox here. If Coinbase is crushing it, SIBO is thriving, the infrastructure is clearly maturing, why aren't we seeing a massive rebound in the asset price itself? Doesn't this disconnect kind of suggest the market's broken, or are institutions just ignoring this fundamental strength?
That's the absolute core tension we need to resolve for you. And I don't think institutions are ignoring the fundamentals. I think they're differentiating very clearly.
Differentiating how?
They see stability, or at least potential stability, in the regulated financial infrastructure being built. That's why SIBO Global Markets, the big derivatives exchange, reported a 15% year-over-year increase in derivatives net revenue. Institutions need these regulated products to manage and hedge the risk that comes with holding the underlying assets.
Okay, so the demand right now is more focused on the regulated tools and the plumbing, not necessarily for just pure passive exposure to the asset itself.
That's a really critical distinction right now. And we see this maturation reflected in new products, too. Look at Grayscale. They just launched the staked Solana ETFs, GSOL, on NYSE Arca.
State Solana, okay.
What's fascinating here is that this product isn't just about spot exposure. It actually incorporates staking yield. It passes 77% of the net rewards directly to the investors.
Wow, okay. So integrating crypto native yield directly into a regulated investment vehicle, that shows some comfort level from regulators and asset managers.
It absolutely does. It signals a move beyond simple price tracking, and the market seems to be rewarding these builders, these infrastructure providers, over the companies that are just pure holders.
Right. We see the stock premiums of companies focused purely on passive BTC holding like Strategy Inc. And Metaplanet, those premiums are compressing, aren't they?
You've absolutely hit on the key shift. The market is now rewarding that regulated infrastructure layer. Why? Because that's where the long-term value creation seems to be centered right now. They're betting on the plumbing, not just the asset price going up tomorrow.
Makes sense.
Strategy Inc.'s stock premium, for example, is at an 18-month low. Investors are basically saying, look, we can buy the asset itself now through an ETF. We don't need a high-price proxy for it anymore, especially if that proxy isn't also generating revenue through fees or derivatives or other services.
Okay, moving on to the mining sector. We have, I think, the biggest corporate story of the day, the proposed $9 billion CoreWeave Core Scientific merger. It's off, officially terminated.
Yeah, and this failure is extremely telling. It says a lot about the shifting value proposition of large-scale digital infrastructure. Core Scientific shareholders, importantly advised by proxy firms, voted against the deal.
Why? What was their rationale?
Well, basically, they believed the deal severely undervalued Core Scientific's core assets, specifically their massive data centers, and, crucially, their power purchase agreements.
Undervalued in what context?
When viewed through the lens of the absolutely booming demand for high-performance computing, or HPC, the kind needed for AI.
Right. So the company's real estate and power deals are potentially worth more servicing the intensive processing power needed for AI training than they are for just securing the Bitcoin network. Wow. That is a fundamental challenge for the traditional mining business model.
It absolutely is. And it validates the structural challenges the sector has been facing. Bitcoin mining stocks, as you know, have severely underperformed the actual price of BTC over the past 3 years.
Why is that again? Remind us of the main factors.
There are really 3 big ones. First, constant shareholder dilution as they issue stock to finance growth and buy equipment. Second, those persistently high operational energy costs. And third, the looming pressure from the upcoming halving event.
The automatic supply reduction event, which halves the reward miners receive for each block.
Exactly, which directly impacts their revenue.
So this merger termination really forces the mining sector to kind of choose a path, doesn't it? We're seeing a clear bifurcation of strategy starting to unfold.
We really are. Path 1 seems to be embrace the market's signal. Pivot more fully towards infrastructure. You see companies starting to de-emphasize pure mining and rebranding themselves as digital infrastructure or even energy companies.
Able to service that broader AI and HPC market.
Precisely. Riot Platform's new 112-megawatt data center campus they just announced, that's a perfect example of this proactive shift toward diversification, building for more than just Bitcoin mining.
Okay, that's path one. And path number two involves more of a political countermove, right?
Correct. Path two is the political angle. We're seeing the Bitcoin lobby pushing quite hard in Washington, D.C. for something called a Strategic Bitcoin Reserve, or SBR.
And the idea there is framing Bitcoin ownership by the U.S. government itself as a matter of geopolitical security.
That's the framing, which, crucially, if successful, would create a large non-commercial buyer, the U.S. government, to effectively support the price of newly mined Bitcoin.
Right, thereby stabilizing the profitability of the mining business model without necessarily requiring that costly, difficult pivot towards AI infrastructure. The sector is truly at a major crossroads.
Absolutely. Big choices ahead for those companies.
All right, shifting our focus now to global certainty, or at least steps towards it. We do have a very positive update from the U.S. Senate, which helps reduce some of that regulatory uncertainty that's been hanging over the market.
Yes, this is important. Bipartisan negotiations on that crypto market structure bill have formally resumed.
Which is good news because it seems stalled for a while.
It did. Senators Boozman and Booker are leading the talks now, and sources are indicating there's a real push, maybe, for a potential committee vote even before the Thanksgiving holiday break.
Okay, so progress there signals growing momentum towards finally providing some much-needed clarity for digital asset businesses operating in the U.S.
Definitely a positive sign. Meanwhile, across the Atlantic, Europe is providing a firm, albeit somewhat distant, timeline for its own central bank digital currency.
The digital euro.
The ECB announced its timeline. They're aiming to be technically ready for potential issuance sometime during 2029.
2029, so still quite a way off.
It is, and that timeline is contingent on the necessary legal framework being fully adopted by the European Union, ideally by 2026. So, steps need to happen first. The goal is clearly stated, preserving monetary sovereignty in an increasingly digital age. But yeah, it's a long road ahead.
Okay. And finally, let's wrap up with a really fascinating demographic trend coming out of India. This offers maybe a longer-term signal about adoption patterns.
Yeah, this report from CoinSwitch is quite interesting. It shows that Generation Z, we're talking about those aged 18 to 25, has officially surpassed millennials. They now account for 37.6% of crypto investors in India.
Wow, Gen Z taking the lead there. That's a significant shift.
It really is. And what's also key is looking at their asset preference within crypto. Bitcoin is the most held token. It's found in about 7.2% of portfolios in that group.
Which suggests what?
Well, it suggests this younger cohort might be adopting more long-term, potentially more stable investment strategies rather than just purely speculative trading in, smaller altcoins. A potential shift towards viewing Bitcoin as a core holding.
Interesting. Okay, so wrapping things up. What does this all mean for you today? We've outlined a really clear tension, haven't we?
Absolutely.
On one side, you've got these macro liquidity fears driven by the Fed's cautious stance. That's a powerful short-term headwind, forcing Bitcoin to defend that critical support zone we talked about down near the minor cost basis.
But countering that, the underlying structure, the foundation, is arguably being reinforced by really strong corporate tailwinds.
Yeah.
You have Coinbase and Cboe with blowout performance, validating these regulated infrastructure business models. And you have bipartisan regulatory progress potentially picking up steam in the U.S. Senate, which works to reduce that long-term uncertainty.
So the choice for you right now, it seems, is framing this tension. Are you betting primarily on global liquidity expectations driving the next month of volatility? Or are you betting more on the balance sheet strength, the performance of the regulated infrastructure driving the next, say, 5 years of growth?
It's about time horizon, isn't it?
It really is. For the immediate future, definitely keep a close eye on those daily U.S. spot ETF flow figures.
Yeah.
We really need to see those institutional outflows stabilize or preferably reverse.
That would be a key signal.
And of course, track Washington, D.C., keep an ear out for any concrete updates on that Boozman-Booker bill moving through committee.
And maybe one final thought to leave you with.
Yes.
The core scientific failure, I think, is kind of the ghost in the machine here today.
Why so?
Well, the shareholders there essentially chose the potential of high-performance computing demand, fueled by AI, over the current profitability of Bitcoin mining. And this raises a really important question for the future. Will the market, going forward, consistently value power and data center infrastructure more for servicing these massive emerging technology demands, like AI,
than it does for its original purpose of securing the Bitcoin network. This growing bifurcation, this split, I think it's absolutely key to understanding the sector's future identity and where the value might accrue, something to really chew on.